Good evening, Canada. Welcome to week 9 of the Investor's Guide to Thriving for spring 2021. Just one more episode after this. Well, everyone, there's a global semiconductor shortage that's quietly gone from being a nuisance to more of a crisis, with companies across technology, telecom, and automotive starting to feel the pain with rolling production shutdowns and warnings that this could impact earnings. Analysts can't agree on how long they expect the shortage to last or how big the impact on the economy could be. The only consensus seems to be that the world hasn't seen a chip shortage of this magnitude since the legalization of recreational marijuana. But that hasn't stopped investors from betting all their chips on black as markets once again make new highs this week. US equity fund and ETF inflows jumped higher with a rolling 3-month total of about 100 billion USD, which, believe it or not, represents the first meaningful positive inflow since early 2018. Heightened investor confidence is also evident in market sentiment indicators such as the AAII Bull Bear Survey, which currently shows bullish US investors outnumber bearish ones by about 32 points. Typically, when that spread goes plus or minus 20 points, most economists take notice as it's historically been a predictive contrarian indicator. Well, if all of this is an indicator that you need some help managing risk in your portfolio, Larry & Co. at ETF Capital Management can help with strategies designed to tame markets so you don't have to time the markets. ETF Capital Management works with advisors through our parent company, Quintessence Wealth, and clients, plus we run some institutional mandates like the ETFs and fund of ETFs in partnership with BMO Global Asset Management. You can learn more about this at etfcm.com. For those who have their investments managed and want to layer on wealth planning strategies, U-Potential is our fee-for-service financial planning firm. And if you just want to read about money, Golden Girl Finance is the original financial media site for women in Canada. And of course, Investor's Guide to Thriving is brought to you by Prosper Experiential Media, the in-house marketing boutique exclusively serving Q-Wealth and its partners. We bring you Investor's Guide to Thriving in support of childhood leukemia research at the Sick Kids Foundation and Alzheimer's and dementia research at the Baycrest Foundation. If you'd like to make a donation, please use the links in the survey you'll receive after the event, or visit investorsguidetothriving.com and use the links on the page. They allow us to track and match your generosity. If you've already donated, Larry and I thank you very much. And a big thank you goes out to our title sponsor, BMO ETFs. Since 2009, BMO have been an unstoppable force of innovation in the marketplace. And being an unstoppable force takes power. And when it comes to power, the future is green. Here to educate you on how ETFs can provide exposure to responsible investing and clean energy in your portfolio, it's Drew Burgess, Director with BMO ETFs.
That's fantastic, Jared, and thank you for the cheerful introduction there, and thank you as well to all of the viewers at home who are joining us tonight. I'll get the required disclaimer out of the way first on the first slide here. Thank you. Just as a formality, it states that the information I'm going to share this evening is strictly for informational purposes and does not represent recommendations or investment advice in any part, whether on investment, tax, or legal matters. And with that out of the way, let's jump right into the discussion. As Jared mentioned, clean energy. My goal by the end of this session is really to leave you with 3 key takeaways. The first takeaway is, what trends are we seeing in the adoption of clean energy across the globe? The second takeaway, why clean energy today for the benefits of tomorrow? And the third takeaway, what does investing in clean energy look like? So I wanted to start on this slide here to set the stage for clean energy, as there are a few overlapping themes that we're hearing and seeing more about today than ever before. So when we think about topics around responsible investing, socially responsible investing, ESG investing, as well as clean and renewable investing, all of these themes have a common foundation. And that foundation being a focus on forward-looking, invest for the future, and really invest with companies who are changing in tandem with our ever-evolving global demands and advancements. And I'd say it's really exciting, to see these transformational changes happening right now in front of us across these themes that I just mentioned. On the next slide, we can take a closer look at what we're seeing across the globe. And a lot has come to the news headlines more recently, but at the core, There is a global revolution and a move towards renewable energy use. We're seeing countries around the world setting carbon emission targets and dates. We're seeing global corporations discussing more and strategizing on ways to integrate more scalable renewable energy. And we're also notably seeing a greater demand from investors to want to know more on this topic and to find ways to invest alongside the best in clean and renewable energy. And most recently, and you can see on this slide, most recently in the news, and some of you actually may be aware of this or familiar with it already, there was an Earth Day summit held last week on April the 22nd, a 2-day virtual summit attended by 40 countries, including some of the big suspect carbon emitters, being China, India, and Russia. But notably, and I look at this and I say, like, I believe it really earmarked the US President Joe Biden's drive to reestablish a leading presence across the globe on the fight for climate change and investment in renewable energy infrastructure. And what came following this summit were many countries announcing, or in some cases actually re-announcing, bolder and more ambitious targets and dates versus previously stated goals. And I think that this, stepping back, looking at it from the outside in, I think it really speaks to how there is this shift to more global alignment, more global intent and ambition to really put these goals into action. On the corporate side, moving forward, we can see some interesting trends and forecasts as well. This is a very interesting illustration. We can look at one of the largest oil and gas giants, BP, and they're forecasting the peak for fossil fuel demand could actually soon be reached. And again, this really highlights how renewables play an important role in our future. In contrast to traditional energy sources, we can think about carbon neutral options such as solar, wind, geothermal, hydro. These all have an unlimited supply and will help create a cleaner and healthier society into the future. And we're already seeing companies and countries alike investing heavily in green energy development in areas like clean transportation, energy efficiency, deployment, and R&D, which are all already having a huge impact on job growth as well as emission reductions. On the next slide, we can take it one step further and look at the industry from a different lens. As with most transformative industries or companies, for that matter, let's think about, for example, computers, cell phones, and now electricity. In a simple sense, as scale increases, the technology improves, and the costs over time continue to decrease. And we're already seeing that with early scaling across the globe when it comes to renewable energy sources and cost efficiencies. And in fact, there is data from IRENA, which is an acronym for IRENA, which is the International Renewable Energy Agency. And they highlight that renewables are becoming more affordable every year, and some options are actually cheaper now than fossil fuels. And I have a few stats here that I'll share. The research and data finds that since 2010, the cost for photovoltaic solar, so PV solar, has dropped by 82%, concentrated solar by 47%, onshore wind has seen a cost reduction of 39%, and offshore wind has seen costs reduced by 29% over that same period since 2010. So the scaling, the improvements in technology, and the cost efficiencies are all working in favor of this ongoing renewable energy investment and transition. Now, shifting gears here a bit, if we take a look at the demand from investors for access to clean energy, we can clearly see there is growing demand. As well, growing demand for product providers to provide simple and transparent tools to access these markets. And ETFs are just one of those vehicles, which I'll speak to in a moment. But what we're seeing over the years, and on this slide that's in front of you, you can see that we use the US as an example due to the availability of data. And be mindful that as Canadian investors, we as a whole have actually been slower to adopt this renewable energy theme. But from a product perspective, as well as an asset flow perspective, we saw huge growth in clean energy ETFs last year, and we're confident that this is only the beginning. At BMO, we were actually in the planning and development stages last year through 2020 and just came to market with an ETF, Z Clean. And on the next slide, some of you may be familiar with iClean, an ETF listed in the US, tracks the S&P Global Clean Energy Index. Essentially, we brought to market Z Clean, a Canadian dollar, Canadian market listed ETF tracking the exact same index as iClean in the US. Now, a bit of a positive twist. For those of you who are familiar with the S&P Global Clean Energy Index, you will know that up until just a week ago, on April the 19th, the index was made up of only 30 companies, very concentrated, all of which were 100% clean energy companies or as close to as possible. But this index was not fully representative of the broader scope of companies in the clean energy space. Now, S&P is a globally recognized leader in index construction and research. And over the past year or so, S&P identified some challenges and restrictions on simply having a 30-company index for global clean energy. And what really stood out to me, I stepped back and I said, hey, wait a second. There are companies who are in transition from fossil fuel heavy business models to clean energy models. Would they have been included in the old index? And it was very unlikely that they would have. So it left a big segment of the market out. With the updated index, it's more accommodative. And I would argue too that it's more aware that there is a large segment of the market that is in transition to 100% clean energy or close to again. But it's, I'd say, again, more accommodative and aware that there are these companies who may never be 100% clean energy producers, but are perhaps largely clean energy focused, may be suppliers of clean energy technology, equipment, or storage. So they have their hand in clean energy, but are not to the same scale as some of the big players that are out there today that made up the original S&P Global Clean Energy Index. So now there are up to 100 companies in the new updated index. It's more encompassing of all, I'd say of key companies who will be involved in driving the transition and transformation of clean energy. And it looks at full market cap and a relevance score to weight these companies in the index. And on the next slide, I'll dive into a little bit more on the relevance score, because the relevance score is important, especially as we continue to see companies evolve from, for example, a 50% renewable energy company today to a 100% renewable energy company over time. A company's relevance score will change, and their weight in this broadened out index will also change. What the relevance score does, to break it down, is it assigns a higher multiple to companies that are 100% clean energy and lower scores to companies that may be in those transitionary phases, or companies who may have some of their business in clean energy today, but not all. So effectively now, with the index including up to 100 companies, along with these assigned weights, there are improvements that have been made. And some of these improvements include reduced concentration risks, improved liquidity in buying and selling of the underlying holdings. And as well, as I've mentioned, it helps to be more inclusive of companies as they continue to adapt to new ways of operation, changing business models, new entrants into clean energy business, or some businesses who may leave. It's really forward-looking, and I'm excited by it because I'd say it's very well built for this growing segment of the market, and the fact that it's growing as quickly as it is and anticipated to continue on this path. I mean, I joke about it, but we don't know who the winners and losers are going to be over the next 1, 3, 10, or 15 plus years. So the indexes are going to evolve, so too are the players that are in this space. And I would argue again that this really helps investors to access more of the market in clean energy development and growth as it evolves. We can take a look at how clean energy has performed versus traditional global energy. And there are just 2 points I want to leave you with from this slide. The first is the incremental and relative outperformance of global clean energy companies versus traditional energy companies over the past decade has been increasing. The second point, not illustrated on this slide, but I want to make you aware of, is that there is a lower correlation between traditional energy and clean energy. So if we're looking at it through the lens of an investment, it could be looked at today as a potentially lower correlated complement to a traditional energy investment in a portfolio. The next slide, a key benefit I should highlight again, if you know a little bit around ETFs, cost is obviously very important, lower access costs to the markets, but also the level of transparency. And we can actually gain a clear look at what's under the hood in an ETF. On this slide here, I just highlight and break down the sector exposure within ZClean, along with the top 10 companies in ZCLN. But a full all-encompassing list of the holdings can be found on our BMO ETF website at www.bmoetfs.com. And I really encourage you to use this site, really to better understand more about what is held within our ETFs, including ZClean or any other investment that you may be looking at. With access to data and more research available, this builds on the transparency. We're clearly able to actually, go deeper into some of the finer details of what's under the hood in an ETF or a mutual fund for that matter. What I'm showing here on this slide is the weighted average carbon footprints, as an aggregate sum of all of the companies within the ETF or the index. And here what we're seeing is that there are significant decarbonization benefits, essentially greenhouse gas emission reduction benefits in using an ETF like ZClean versus the global global traditional energy index. So if we're looking at it from a responsible investing or a clean energy investment perspective, the clean energy has the upper hand. I think it's also on the next slide important to showcase some of the other products that are out there, as there are many options. We always encourage you again to do your homework, look under the hood, and really understand the methodology behind a product before investing. We can see here too that there is a variation in costs for clean energy ETFs in this example, but as with all investments across the board. So be mindful of what an ETF does, how it invests, as well as the fee that you're paying for it when you're doing your homework and due diligence before investing in any investment. I have 3 more slides to just finish off with, and this one, I wanted to include it in this presentation. It's not a topic very often, discussed, but important in my mind. What is active ownership in the investment business, and what does this mean as an ETF provider? Active ownership and recognition in active ownership essentially identifies our efforts as an investment firm on working with the companies we invest in, to essentially encourage good companies to be great or for great companies to be exceptional. I mean, at the end of the day, these companies have our money and we want to ensure that they do become better over time. BMO's been recognized as A+ by the UN PRI on our active ownership practices. And I strongly back that. I believe that this is an important differentiator versus our competition, in that we are recognized as a leader and a role model when it comes to our active ownership. And what we're illustrating here is that there is a big difference between BMO and how some of our peers engage in proxy voting. And what stands out is that we're not afraid, and we often have a loud voice in voting against management on many topics, but many that relate specifically to the ESG pillars. So this is important to keep in mind when we search to work with or when we look to invest with companies who are actually leading the way on sustainability. Before I close off here, I just wanted to highlight a number of other responsible investment products we have on our shelf. We have partnered with MSCI and brought to market 4 broad-based equity ETFs tracking the ESG Leaders Index, one of the most widely tracked ESG indexes in the world. We have 3 ESG fixed income ETFs. Most recent is the ESG High Yield US Corporate Bond ETF. As well, often overlooked in some cases, but an all-in-one asset allocation ETF, a simple one-ticket solution with automatic rebalancing and offered at an extremely low cost. I invite you to, if you want to know more on ESG products available in Canada, I encourage you to visit the RIA website. You can see the link at the bottom of this slide, but at the RIA website, they'll outline all available ESG products in Canada, so you can dive deeper on that site. And lastly, to close off, if you're also interested to hear more from us on our market insights, including ESG, more on renewable energy, and other timely topics, on the last slide, next slide, we will run a weekly market insights webinar Fridays at 1:00 p.m. This week is on the NASDAQ index. I encourage you to join. You can register for free at the URL at the bottom of this slide. As well, we have an exhaustive list of our past recorded market insights webinar sessions, covering off many other topics in the ETF markets. And as with these sessions, the market insights are all about you, the investor, helping you to better educate you on current topics, themes, and ETF investing. And with that and time in mind, I will hand the stage over to Larry Berman.
Drew, thank you very much from our nation's capital, where there's no shortage of cash to go around. I'll just put it that way. Anyways, thanks a lot, Drew. And again, thanks to our friends and partners in education at BMO ETFs. So digging right in tonight, bit of an update again on our Pro-I series. Our high caution alert remains. In fact, today for our ZZD portfolio, we added a degree of protection in terms of reducing our volatility to markets. Those option strategies I've been talking about to buffer market exposure, well, we just added that to increase the sleep at night factor in our ZZD portfolio. So I think when market conditions exist, I think you just have to be able to protect. And in the world we live in today, just going to cash is not the right answer, because I've not liked the market for a while, but that really doesn't matter because the market keeps going higher. So we have to find the tools so that we can participate, even though we may not like the reason why the market's going up, but nevertheless going up. And so, these hedging strategies to dampen volatility in portfolios, to, as my friend Jared likes to say, tame the market, not time the market. And if we can tame the market when it needs to be tamed, the long run takes care of itself. Another way to learn how to tame markets is to look at factor investing. And I just a play on words from the Joe Friday era, just the factors, ma'am. So I'm going to drill down into some factor investing that I talked about on BNN this week. I'm going to specifically drill down in technology, and I'm going to show you how we go about selecting what names to own in our stock-based portfolios that we have for our clients, and give you some tools that you can do these things too. And of course, our traditional question and answer period. But first, a little shout out to my Toronto Maple Leafs. I've been a very depressed Leaf fan since I was 2 years old when they won the Stanley Cup in 1967. And this is the year, folks. So big shout out to the Leafs. They've clinched a playoff berth. Phase 1 complete. Okay. And I won't mention that those Ottawa guys for Drew are at the basement. Anyways, okay. So again, Pro-I series, if you haven't had a chance, please check it out, follow along. There's a link here on the presentation, but a quick Google search of Berman's Call Pro-I's and you'll find the webpage. 4 measures of valuation, still very extreme. Our business cycle model, still very supportive given the shape of the yield curve, given the support from central banks in terms of liquidity to the marketplace and driving the equity risk premium to very low levels. and generally the uptick in the economy. Obviously, if you're going to spend trillions and trillions of dollars, you're going to generate growth. At some point in the not too distant future, we're going to have to pay for that growth. The piper always needs to be paid. Monday is a very big day, folks. The Treasury announces its quarterly refunding. And as you may all know, the Fed is now buying 120 billion in debt securities a month, which includes 80 trillion or billion of treasuries and 40 billion of mortgage-based securities. So that's roughly $1 trillion worth of treasuries a year. They're going to need to fund to pay for the promises that they just made to everybody and the checks that they've just written. 2.5 trillion approximately. That doesn't include any of the 4 trillion President Biden talked about last night, and what that number ultimately is and how many years they spend it can be debated, but there's still another big amount of money that needs to be raised. The Fed talks about tapering. The market says, Jerome, Mr. Powell, when are you going to taper? And he says, we're not ready, because as soon as the Fed takes their foot off the gas, all those bonds aren't going to be bought by the Fed anymore, and yields are going to go up, up, and up, and that's going to stress markets. That's going to take equity risk premiums and push them higher. One of the questions that Mr. Powell was asked yesterday in the press conference, he talked about frothy valuations in equities, and he says it's not something they're concerned with. If you remember back in December of 1996, Chairman Greenspan at the time, who was running the Federal Reserve, used the phrase irrational exuberance, because at the time in December 96, the price earnings multiple of the S&P 500 was equivalent to what it was at the peak in 1987. And he said very simply, how are we to know when the markets are becoming irrationally exuberant? And therefore, what should we do about it? And the market took that to mean the Fed was going to start raising interest rates, and had a 10% sell-off in the matter of a couple of weeks. So when the Fed does give that signal that they're going to back off or they're not willing to buy more, which I believe we will see over the coming months, all that supply is going to push bond yields higher, bad for bonds, and that's going to cause some anxiety in equity markets, because the single biggest driving factor beyond earnings going up is the fact that money's cheap. And if money gets more expensive, meaning bond yields go up, the equity risk premium goes up, stock valuation multiple must go down. That's just a logical how markets work. So again, $180 now in earnings. Remember, we talked a few weeks ago about earnings. They were going to be $174 this year. Earnings season started. Now it's up to 180, could be 184, 85 by the time earnings season's finished. Although we got the bulk of the big tech companies out of the way this week, with Amazon reporting today. And so at a 20 multiple, which I think is expensive, but a 20 multiple would be a US 10-year rate of about 2.5%. If you just do the math on how equity risk premiums work, we're at 1.5 or 1.65 right now. So bond yields go up to there, multiple goes to 20, 180, 185. That gives us a 3,700 target on the S&P at the end of the year, if they let bond yields go to those levels before they step on the gas again. So that additional support, never mind tapering, the Fed's going to have to step on the gas and buy more, because the supply coming is going to be way bigger than this marketplace can handle, I believe. So we'll see how that all plays out. But all of those things together, including our technical indicators, tell us we're in a very high degree of caution. So last week, the Pro-I's composite was down 1.4%. And again, go have a look at the website, read about the individual factors and their influence. But remember, when we're at this high caution level for the composite index, What has happened over the last 20 years historically is within 3 months, we get a drawdown that has a median of 7.5 and an average of 11.3%. Now, obviously, COVID was a thing that caused some of those outliers down there you see at the bottom, but on average, you can see the massive amount of dot plots on the drawdowns. And sometimes it's only 2 or 3%, sometimes it's 5, but you can see that median is around the 7. And so this is the dot plot. This is Larry's dot plot, right? The Fed has their dot plot. This is my dot plot. And when the caution levels are high, pay attention to the dot plot. Very important to understand. So back in 2012, I was in Mexico and we saw this artist at the hotel, and he did these great sculptures, and I just fell in love with the work he was doing. And I showed him a picture of me, and I said, I got my two friends. I got my bull and my bear friend. And back in 2012, I actually showed this on Berman's Call. I had a laugh with it. But I thought it would be a good time to come because to show this, because I'm not a bull or a bear. There's the perception that is I'm bearish, but it's because I look at these risk indicators, and really for the last 4 or 5 years on average, we've been, high risk, and it's been the valuation component that's really been very, very high. But prior to COVID, remember the yield curve inverted, the markets were forecasting a recession. You just never know what the catalyst is going to be. So that business cycle element right now is not forecasting that recession. So the probability when we get a correction now is not going to likely be a big one. It's going to be a median type one, which again falls in that 10-15% range, kind of at the outside. So when we put our protection on the sleep at night portfolio, I put it down to 3,800 now. So we're just over 4,200, roughly 10% lower, which would basically wipe out the gains this year that we've seen on the S&P 500. In any case, one of the other ways we can shift our risk around in portfolios is by using different factors. A couple weeks ago, BMO did a factor-based presentation where they talked about low volatility and high dividends, so and quality, which is a suite of ETFs. BMO has a lot of quality, and I chose this week to talk about quality and do my educational segment on it, and I want to expand upon that tonight because again, in a couple minutes after the end of every show, I don't have time to go deep on a topic. So I've used a lot of these weekly webinars to drive a little bit deeper. And it's really important to understand this. And this week was key to do it because of the big tech earnings and the quality and momentum factors that I'm going to talk about tonight specifically have very, very big weights in the technology sector. So when you think about, protecting, it's about dampening the volatility, right? It's about minimizing the risk, not eliminating it, right? Trying to time the markets being all in or all out. I've been at this 35 years now, folks. I haven't figured out a way to do it. It's just too hard. But what we can do is add that bit of a sleep at night factor. And that when the risk factors are high and we're in the caution range, we do things that give us less risk, okay? Now, for some of you, that might be to go to cash, and for some of you, that's okay. But right now, cash doesn't pay anything. And I've spent a lot of time over the last 10 weeks talking about different ways and different ETFs to be able to dampen that volatility without using bonds, because as I've said a few times, bonds are broken. So fixed income isn't a factor here. Asset allocation is, but this is equity market factors. Now there's macroeconomic factors, which are business cycle, right? Economic growth, business cycle. So those risks right now are moderate. Real interest rates, that's a factor that we look at in our ProEyes indicator. What are real rates? Inflation adjusted interest rates, and they're very stimulative right now. What is inflation doing? Again, another part of our Pro-I series. So all these macroeconomic factors, credit, there's another one that we're bringing in to our business cycle factors. Then there's some trading factors. Where are you in the world? Political risks. Largely, they come from emerging markets, but political risk in terms of a dramatic change in January when the Senate flipped and Biden got control of all three houses and now is able to spend trillions of dollars without anybody's approval, right? Just because he has that ability to do it. It was very interesting when Trump took over in 2017, the first thing he tried to do was play with healthcare and entitlements. And even though he controlled the White House and both houses of Congress, he couldn't get anything done. And the moral of that story to me, folks, was that when you make a promise to someone for an entitlement, i.e. you get this, you can't take it away. And so the biggest cost to the US government is social benefits. And when the government makes a promise on a program, it doesn't matter who's coming up next, it's virtually impossible to take it away. So the cost of government is going to go up and up and up and up and up and up and up. And budgets will never be balanced in the future. I'm so convinced of this narrative. And it sounds like I'm bearish. And the solution is MMT. The solution is modern monetary theory and printing money to pay for it all. And as I outlined probably 2 months ago now or 6 weeks ago, that's part of the future, right? So one of the ways that we can dampen volatility and modify the risk is by tilting the portfolio to different factors. Value stocks have been doing well lately as opposed to growth stocks. Low volatility or minimum volatility is a factor that and quality is another one. Momentum is a factor where, price earnings, growth, those stocks tend to do well. So all those things come into play. When we talked about building indexes, the default to an index, and the world we know and the names you know, the S&P TSX, S&P 500, market cap weighted. That's the default. So your benchmark index of the world is the S&P 500. If you're Canadian, it could be the S&P TSX, but that's 3% of the world, where the S&P 500 is 40% of the world. The entire US market, 58% of the world today. So I always look at the US markets, but the Dow Jones Industrial Average is a price-weighted index. And that's a crappy way of building an index. Because, the fact that the stock is $500 compared to the stock in the index that's $50 means that $500 stock's 10 times more important. But it's not. The index was designed to initially to look at an equal weight companies. And 100 years ago, the prices were very similar. And he created this because the math was easy. You could add up 12 stocks and divide by 12 and create an index around it. And as time developed, the price-weighted index is terrible. But the Dow is a benchmark that people know, but it's a terrible benchmark. Okay, Apple did not get included in the Dow because when it was $700, it would have been too big a player in the index. So they split the stock 7 for 1, and it came down to $100, right? And then it was eligible to be put in the index. So there you go. Tesla would never get into the index. Amazon will never get into the Dow, even though it's the biggest retailer in the world. But if Amazon split from $3,400, $3,500, where it's trading now, to $35, it would probably be considered to be included in the Dow. Go figure. Okay, so I'm going to take a look at some of these factors, and this is a sheet that BMO put out in their presentation a few weeks back, and I thought it was a great thing that I could reiterate. So I want to look at the quality factor. That's the pink boxes. And you can see in some years, they're the worst performer. Other years, they're amongst the best performers. But what the quality factor is companies that have a clean balance sheet, don't have a lot of leverage, have good earnings, consistent, names you want to own, right? But you can see in 2003, 4, 5, and 6, the quality factors did terrible. Turns out the quality factor is overweight in technology. And technology, coming down from the bubble bursting in 2000, even though it turned in 2003, still underperformed. And a lot of the quality names that were in the index at that time were lagging the broader markets. Money was going into the banks, it was going into energy, it was going into a lot of things that have a lot of leverage on the balance sheet, generally speaking, and don't typically fit into the quality bucket or fit very well into the quality bucket. But as technology took off, the quality factor started to do better and better and better over time compared to some of the other factors. So GT is growth or momentum. MT would be momentum. GT would be a growth factor. VO would be your volatility factor, so low vol. YD would be the high dividend or yield factor, and VL would be the value factor. So in 2020, value stocks did the worst. In 2021, value stocks are actually doing the best. So the factors outperform and underperform, and they shift. So look what happened as the tech bubble was breaking in 2000. Remember, tech and momentum, growth, those are overweight tech. And they were all at the bottom. And what was high? Low volatility and value. Money was coming out of the bubble of tech and going into the, reopening. Today it's the reopening. Back then it was the value stocks. Money came out of Kraft and Gillette and Coca-Cola and McDonald's and went into dot whatever in 98, 99, 2000. And then as the bubble burst, it came out of there and went into the value. So that's what's happening now. And this is why I said months ago, late last year even, that I like the equal weight way to play an index relative to the market cap weight because it overweights value. Okay, so that was one of the big reasons how I got value introduced into the portfolio as a factor. I don't like value. Value tends to lag in long periods, but sometimes value does great, right? So growth at a reasonable price, but a lot of value names, stay cheap. And when the markets are hot, value tends to lag significantly. So it doesn't always pay to be a value investor. But also what that does, equal weight versus market cap weight of an index, is that it overweights the size factor. So SZ is the size factor. So in an equal weight S&P 500 with 500 stocks, each stock is a 0.2% weight, right? Adds up to 100. Compared to the market cap index, where Apple and Microsoft and the big, top 10 names that make up a third of the index, right, are significantly overweight. And that's fine when they're working. But in the environment we're in of higher rates and everything else, those stocks are going to lag. Okay, so the quality factor that did well the last 2 years, as much as I like it, is probably going to underperform a little bit. Come back to it when it makes sense, when valuations overall improve in quality. So one of the keys to the sleep at night factor in building a portfolio, again, another chart from the BMO presentation a few weeks ago, is that when you look at the broad market cap weighted benchmark in the middle there, over this 20-year window, historically, you had a little over 7% with a standard deviation, right? A VIX of about 15. That was the S&P 500 basically. When you tilted towards dividends, you got a little bit less risk and you got a little bit more return. When you tilted towards quality, you got a little bit less risk than that, a little bit more return. When you tilted towards lower volatility, you got a lot less volatility, obviously, because that's the style, and about a similar return to quality. When you took an equal weight index, you actually got more volatility, but you were compensated by significantly more return. And when you went into a value tilt, that actually did very well. But the vast, vast, vast majority of those gains in value came in the early part of the 90s, where the last decade value underperformed significantly. But it was because when you look at this window of 98 to 2019, you know, technology was at a peak in the early part of that, spent the best part of a decade going down, finally recovered and went up. So your average return in that factor was lower compared to value that from 98 was really depressed and recovered. But again, most of that recovery was 98 to 2000 and, you know, 4 or 5 approximately. Okay, so it's important when you look at a chart like this, you understand and you have a little color behind it. I think it is. So the size factor. So this is where the chart I showed this week, where I looked at the RYT, which is the equal weight 75 technology stocks in the S&P 500 index compared to the market cap weighted version, XLK. And what you can see here, going back to the beginning of when those ETFs were put out in the marketplace, you can see that when the markets were going down, generally, equal weight actually underperformed. So the average stock underperformed when markets were doing poorly. When markets were doing well, sorry, the other way around. Yes, no, that's right. When markets were doing well, the average stock did better. So that yellow line is rising when the markets are generally doing well. And when you go through a difficult period, so through the great financial crisis, 07, 08, 09, large cap quality names, money went into the more mature companies, more stable in terms of technology. Doesn't mean they all went down. They just went down less. And so, you know, prior to the meltdown, that ratio, so the bottom chart on the right, the ratio there was at 1. That's equal. Divide one by the other, neutralize it, it's equal. When that index falls to below 80, one is underperforming the other by 20%. When it's going up to 110, as you could see at the peak there in 2019, then that factor is outperforming by 10% compared to the other factor going back to the beginning. So as things started to come undone, as interest rates started to go down, those large cap tech names were working. So COVID hit, money went into the dot-coms, not dot-coms, but those work from home stocks, sorry. And those were dominating the capitalization. Apple kept getting bigger, Microsoft and so forth. And now we're seeing the earnings results from all of those. And what did you see with Apple? Gap up, great news, sell into it. What did you see with Microsoft? Great earnings, fantastic, gap up, sell into it. Apple, right? So think Apple, increased their buyback to $90 billion. When you think about what that means, right? So $90 billion is the buyback in Apple, the added buyback. They just announced. The market sold into that. Got to be priced in, right? of the S&P 500, 400 stocks in their entirety have less than a $90 billion market cap. So what Apple basically just said is we're going to buy back 90 billion of our own stock, but we could actually buy any of those 400 companies we want now with cash, right? So that they chose to buy their own stock back to that degree where they could have bought any of those 400 companies and maybe 5 or 6 of them or 10 of them, right, with lower valuations. And the market said, eh. So that's kind of telling me a lot of good news is priced into tech. And so if you're going to be there, I wouldn't be in the Qs, or RYT would be the way to play it on an equal weight basis if you want to be there. To me, I'm pretty nervous on the sector. So let's have a look at the quality factor, because the quality factor, oh, my bad here. I didn't update these charts. These are the same chart as the other page. What I should have put in here was the quality ETF. And so QUAL, my bad here, folks. Oversight on my part. I'm very sorry. QUAL here. So maybe I can, I'm not going to do that. QUAL here relative to XLK. And I just wanted to highlight that factor. So my bad on me. But remember, what's the quality factor? So the quality factor, these are companies that have very good clean balance sheets. They don't use a lot of leverage. Tech stocks generally don't. They have a lot of cash, like an Apple and Microsoft, a lot of cash on hand. They don't have a lot of debt. It's not a huge capital intensive business. Once they create the software, their cost of the next sale is basically a digital copy, right? So that's their margins are huge in that business, throw off lots of cash. So they have very clean balance sheets. There's not a lot of need for leverage in these names. You know, it puzzles me why the activist shareholders, you know, tell companies like Apple, listen, money's cheap, guys. Go borrow money. You can borrow for 10 years at 1%. Go buy back your stock. And so they've been doing that, right? So that boosts earnings per share, and you know the story there. So quality factor, good return on investment. These are really, really great companies on average. The momentum factor, and again, bad on my part, this was supposed to be the momentum ETF relative to the market cap ETF chart. Again, bad on me. So apologize for that, folks. But what is the momentum factor? And there's different definitions depending on what you're looking for. But as iShares defines them in the MSCI index universe, risk-adjusted excess returns for the last 6 months and then for the last 12 months. And they kind of take a weighted blend so that over time, you're in a company that is showing excess price returns. So not only do you have a company with good, clean balance sheet, good return on, so good financials, you also have a company that's generating excess returns. So when we drill down, and folks, what I'm doing here is I'm taking you through my investment process on how I go about selecting what stock to buy in our stock-based portfolios. So when you get into the sector, so what I have here is the list of all the sub-industries within technology. Here are the names: communication equipment, technology, hardware, and storage. That's where Apple falls into that group. And you can look at the capitalization weight of that index. So I've taken the XLK ETF, I've exploded it out with all the names and their weights. I've added up all the weights. And on the ETF XLK basis, communications equipment, 3%. Apple and the other technology companies, 23%. 21% of that is Apple. System software, what's the big name in there? Microsoft. Microsoft and Apple together, 42% of XLK, compared to the equal weight version, where those two together are 2.6%. That's the big difference. So you're overweighting the size factor, and you're giving more emphasis to the breadth of companies So when the industry's doing well, you want all of them. You want to own all of them. But if you want to know which one you should own, what I do I look for the names I want to own, and I want to own the best one or two names in each sector. So because semiconductors are hot now and there's a shortage, and Jared talked about that tonight, I'm going to drill down here into the semi names. So there's semi equipment. So those are the companies that produce components of semiconductors. These are the companies that assemble semiconductors. So obviously Intel, they put the chips together, NVIDIA puts the chips together. They don't make the little thing that goes in the chips, they just assemble them. So those are the differences between the two groups. So NVIDIA, by market cap, and going back and looking at the weight of this group, semiconductors, 16.76% of the weight in the index, equipment is 3.19. Again, boom, exploded out. So AMD, Analog Devices, Broadcom, Intel, Maxim, and you can see the names there. So what I did was I said, okay, let's look at the size factor. How big are these? So if we were looking at an equal weight exposure by going into RYT, 75 names, 1.33% would be an equal weight. Okay, so 1, 2, 3, 4, and you add up all the names here. So this sector, semiconductors, are going to be overweight compared to the market cap weighted index. Because if you take the 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 12, 13, 14, 15 names and multiply it by 1.33, you're getting roughly 19%. And in the market cap weighted index, it's 16.77. So you're going to be slightly overweight semiconductors. You're going to be very overweight semiconductor equipment. But if we look at the individual names, there's not one single name in this group, including the biggest one, NVIDIA, and then the second biggest one, Intel, that is 1.33%. So you can see what's happening to your exposures. So what I've done here is I looked at the MTUM ETF, again, momentum factor, MSCI, iShare ETF. And I said, which one of these screen for momentum? So AMD, Monolithic, NVIDIA, NXP, Qorvo, and Qualcomm, and Skyworks. Which one of them are in the quality factor? Intel, Skyworks, Texas, and Xilinx. So I decided to pick Intel because it's got a bit of a value tilt for me. And I decided to look at Skyworks. So when I picked a bunch of these names that fall into these, and I said, what are they doing relative to the equal weight technology index? So the orange line, dotted line over the last year, that is the Invesco RYT ETF that we've showed in the charts. The 4 lines above it are Skyworks, Qorvo, NXP, and Monolithic Power Systems. And the white line is Intel. So remember, Intel messed up. First of all, Apple a year ago said we're not using as many Intel chips. We're going to make our own. We heard about that today in today's earnings. So far been very successful for Apple in terms of boosting their profitability. Intel took a chunk down on that. Then Intel was supposed to go to the next generation chips and they weren't ready yet. And they were having manufacturing issues and COVID and this, that, and the other thing. In October earnings, they had another chunk down. And then the stock got really cheap, right? And eventually when something's cheap, you want to buy it. We had this big run up, relative strength. So what's happening relative to an index is very important. If you want to beat the index, you want to be in the name that's outperforming the index. And the next step in the process is looking at the absolute return. So here's the chart of Intel on top, and I have my standard deviations bands, my linear regression. Middle line is 0. That's a straight line through the trend. First sets of blue lines, 1 standard deviation. Second set of blue lines, 2 standard deviations. And the yellow line at the bottom is Intel's relative performance compared to the equal weight XL or RTY, technology equal weight index. When that yellow line is going up, Intel is outperforming. So again, going back a year, the index starts at 1. When that index bottoms out in December below 60, it's underperformed RTY by 40%. So there were those big earnings misses and those big guidance downgrades. You can see actually 3 of them there. That Intel, that explains most of the underperformance of Intel. But at some point, it gets valuable. It gets cheap. Intel is still a big company. And so you had a number of big hedge funds and value guys start to buy Intel, and it started to outperform. And then recently they started to miss again. So, and then just a couple of days ago. Anyways, so there's the chart of Intel. And right here in the middle of the range, I would say, you know, maybe half a weight in Intel if I was going to be in the name. If I was writing puts to buy this in my portfolio, which we write puts to buy the names we like. So we look at all those 15 names in that semiconductor space. And every month we say, which is the best one that I either want to own today with a covered call, because I want to own it, but I want some extra yield on it, because technology stocks don't yield much. And most of these don't. Intel does, but most of these don't. If I don't want to own it today, where am I going to write a put where I want to own it? And I would look at Intel and I'd look at that chart and I'd say, you know, boy, below 50, it starts to get interesting, right? So at 57 today, can I write a put on Intel, right? So can I look at the option chain on Intel? And I'm going to bring that up right now in a chart so we can have a quick look at that. So there's Intel. So hopefully you'll be able to see that. There we go. I'm just going to blow that up here. And the May expiry, 50 put on Intel right now. I could sell that for 5 cents. Why bother, right? There's not much of a yield there. So where can I earn 0.5% or 1% on Intel for May? And the answer right now for 1% would be around 55.50. Okay, I can get 0.5% around 54. So the question is, between now and the May expiry, do I want to buy it at any one of those prices? Okay, let's say that answer is no. Well, how about for June? Turns out the June 50 is trading at 23 cents, and I could probably get 24, 25 for it. Last trade was at 26, right? So I could probably pick up close to 0.5%, maybe 40 basis points, but between now and the expiry in June. If I want to earn 1% on that name, I'm going to have to write the 52.50 for 52 cents, last trade at 50. So I could probably earn 1% between now and the June option expiry. And I would, if Intel's 50 or lower, I have to buy it at 50. And that's the question. So do I do that? Do I want to be long Intel with a covered call today? Or do I want to wait and buy it at a better level? Well, Intel's been an underperformer. The yellow trend is down. Yes, it's been up recently, but it's been a long-term trending underperformer. Or do I want to own a Skyworks that's been an outperformer? Now, right now on trend, it's overbought and it made a reversal pattern today. You can see that in the chart there. That would have been as of yesterday or as this morning. My relative strength line, again, it's trending up. The slope of that trend is up, so it's outperforming the index compared to a year ago. But right now, it's neutral at best. So would I own this? Well, let's have a look again at our chart here, and let's have a look at the fundamentals of Skyworks there. And say, well, what do the analysts think of Skyworks? So it's currently at 195, 197. The analysts think a year from now it's worth 205. Not the analysts are always right. The really bullish analysts are 220, 245, 230. So that, it's 10, 15% upside from here on a big volatile tech name. Where are the bears on this one? So if we sort by price here, we could see some of the bears, the recent forecasts. So this week, last week, 175, 176, 188. So the bears think it's a hold, right? So there are a lot of holds on this name. So again, where would I want to own this? Would I want to own it now? And the answer would be no to me, because there's not enough upside. I want at least 20% upside to my price target. So can I write something? If my price target for the analyst is 205, can I write something at 175, 170 that's going to give me enough upside over the next year? So let's have a look. Well, May 175s, I could earn 74 cents now, last at 85. So let's say I can sell it at 85. That gives me about 0.5% to May. I look at the June contract and I say, okay, June 170s. Wow. So I could probably get almost $2 for the 170. So let's look at our chart again here. So I can buy this at 170. Well, geez, it was only there a few weeks ago, right? So this could easily get to 160 before we saw the March low and the rising 200-day average. So would I be okay at buying it on a pullback to 170? And that's the analysis we do to figure out when do we buy and what do we buy. And we do that for all the names. And every month we pick the best name. And that's the semi stock we're going to own that month. And we'll bring in some internet. We'll bring in Taiwan semi ADR, and we'll bring in some big international names too in the various spaces where there's names we would want to own. And we do that analysis. And that folks is the process and my drill down on technology and how we go about picking names that go in our version of the ZPay portfolio. Now, BMO doesn't do that. They have a much more index-based, regimented type process. So there's some discretion involved, but generally that's how. So there were a few questions tonight on how ZPay works, and I'll elaborate a little bit more when I get to that. So I really like the strategic approach of using buffers in the current macro environment climate. Even though the underlying investments are in broad indexes, would it be too risky to have a significant investment such as 50% of my total in one company, such as Innovator ETFs or First Trust? So here's what you need to know. You don't need to worry about the solvency of Innovator or First Trust, because an ETF is a segregated product. And the ETF owns the underlying securities. The Innovator doesn't own the securities. They just run it. So in a worst case scenario where it's not a note, so here's where when you're looking at an exchange traded product, if it's structured as an exchange traded note, then there's a counterparty risk, because what you own is a bond. And the bond has a promise to pay a return based on something happening, some index return or whatever. But the risk is on the counterparty. If the counterparty goes bad, then that's a problem, right? That's not what these ETFs are, whether it's First Trust or Innovator. They own the underlying securities, and you don't need to worry about the company insolvency. If the company were to go out of business, the ETF, the process would be to probably roll those up or run them until they mature and then close them down. Something like that would be part of the bankruptcy process. But more than likely, another ETF company would come in and assume the ownership of that and buy them before they even got close to that. So I wouldn't worry at all about the risk of the index provider at all. And I believe that was your question. Can I have your opinion on HXS versus the Vanguard fund? I think VFV for a position in the S&P 500. So the way Vanguard does it is actually done I believe this is with their total return swap strategies, and so there's a bit more tax efficiency in this version compared to the Vanguard version. I don't believe there would be a taxable distribution here. So the Vanguard version that would pay a distribution every year, this one does not do that, I believe. But so there's a bit more tax efficiency with this structure than there is for the VFV. If you look at the VFV, it's one less basis point. Let's do a compare function here where we put the Vanguard version, HXS. I can put the XSP in there as well, which would be the equivalent iShare, and I could put the BMO one, and I could put them all in there. But if you just kind of look at them, okay, one of them's got a currency hedge, and the other one, this one's CAD head, and the other ones aren't. So what is the unhedged version one? XSP is hedged. So iShare S&P 500 CN XUS. That would be the one to compare to. They should all be the same then. Okay. So having a look at them, the Vanguard one had the higher return, and the other two were actually equal. But here's the difference. So the Vanguard one and the iShare one had a price change of 26.57, 26.38. The HXS had a price change of the whole amount. So there was a distribution by way of a dividend in these two that makes up the total return, and therefore you're going to have to pay tax on that where you're not on the HXS. So in a taxable situation, the HXS is going to be a better solution for you than in the Vanguard one if that 10 basis points matters. There's no guarantee that 10 basis points will be there in the future. If I looked at a different time frame, say a 5-year version of this, you're seeing the Vanguard version at 3% better on average every year compared to the other ones. Part of that is the MER being a little bit higher. There could be some tracking error in there too. I'm not sure. I'd have to check what the tracking error differences is to know that. But again, you would have been paying tax over the last 5 years on about 16% of the return annually. In those two, there would have been no tax if you didn't buy or sell it over those 5 years. So great question. Tax time, always important to think about that, but that would be the big difference there. I have some US cash that I would like to invest in 1 or 2 US ETFs that would provide some income, but mainly secure growth so I won't lose in a correction. Any good advice? I got news for you. Whoever wrote this question in, stop investing. You won't lose? Really? In a correction? Doesn't exist. Even these buffer ETFs that are the best things than sliced bread to help you through volatile periods will have volatility. It doesn't exist that you can put money in the market that provides income and growth that won't go down in a correction. Doesn't exist. Everybody wants that. The buffer things are about as close as you could get, I think. ZPay, I'm a big investor, can explain what makes the ETF go up and down. I talked about how I write options. And so on average, the ETF is going to be long a bunch of US stocks with a covered call. The options and the dividends of the stocks generate part of the yield. Writing the puts to buy the other stocks when they go down generates the yield. So that yield, 6%-ish is the target. Trying to be on average half long over time. Okay, market goes up, stuff gets called away. They make money on the stocks going up, it gets called away. They write puts to buy those names back. On the market goes down, they get longer because they've written puts. So market goes down, buy low. Market goes up, sell high, hold time, 6% return. So that's why it's a great holding. It goes up and down because the underlying securities go up and down, right? Now, depending on what version of ZPay you own, there's a currency part too, because all the holdings are in US dollars. So what the Canada-US exchange rate is doing is a factor. And if you don't want that currency risk, you can buy the currency hedged version /F, I think is the currency hedged version of ZPay. Any comments on the Biden address, especially the spending, taxation, and market reaction? Well, a lot of that was leaked. As I said, inequality, I started talking about this a decade ago on Berman's call. Inequality is the single biggest problem the world has. The haves have more, the have-nots are worse and worse off. More and more people every month, paycheck to paycheck to paycheck. While it is true on the global scale, the level of poverty has gone down significantly, and that's a great thing, make no mistake about it. The middle class is getting gutted and gutted and gutted and gutted, and more people are paycheck to paycheck to paycheck. Because what is driving the world today is money printing, government spending, and what is good investment by a company is not buying back your own stock. What is good investment is building a new plant and hiring people and building more widgets. That is good for economic growth. There's an economic multiplier to that. You take that same $90 billion and you buy stock, your own stock, and that just boosts earnings per share, making the people who own your stock richer and making inequality worse. If they were to build the plant and build more chips and do more things and create more jobs, that puts more people to work. That's better for the economy. And, politically, most of you probably know this because I've said it many, many times. Fiscally conservative, socially liberal. If I was in the US, I'd probably be a Democrat, but a fiscally conservative Democrat. I think the Republicans, since Trump kind of off the reservation, but I'm a member of the Conservative Party of Canada here because I believe that the Liberal government and the NDP governments in Canada simply have absolutely no respect at all for our tax dollars and don't know how to spend it effectively. So when it comes to government policy and taxation, I have strong opinions. Everyone may not agree with me, and that's okay. Maybe we have a different worldview, and that's just fine. We'll agree to disagree. And so I like a lot of what Biden's trying to do. If I was the boss and I was running things here in Canada, I think a certain degree of free post-secondary education paid for by the tax dollar is a good idea because that's going to improve your skill set that's going to make your workforce more productive. But you also need incentives for business to build more plant and equipment and create those jobs. Not just to pay the same worker more money for the same job, although that's important too, right? So if you've got a company that has margins like this, they can afford to pay the average worker more. Now, that's not good for the stock price, so the C-suite isn't inclined to do that, but it's very interesting to see the Amazon model here and what happened in Birmingham, Alabama a couple weeks ago with the union being voted down, and what Amazon said today about we're going to pay employees more and that's going to cost us, but it's okay. And so it's very interesting what's going on here with all these policies. And to me, it's very exciting. It's prime time kind of stuff. So, listen, the piper needs to be paid. You can't just say, I want to stimulate, I want to do this, you got to pay. And the balance of payments we talked about last week is gross. The debt compared to GDP is going to be 200% in 30 years. It's uncontrollable. And unless that spending creates a multiple, giving people money, I get because of COVID, they had to do a degree of that, but just writing a person a check is just stupid economics. There's no multiplier whatsoever, right? So you need policies to create jobs, to increase productivity. That to me is so important. Now you got to do a lot of things. The fact that the US doesn't have universal health care to me is incredible. That the biggest economy in the world does not have a system where you just don't need to worry about. A lot of people don't go get medical treatment because they can't afford it. To me, that's a catastrophic failure of government, right? So again, I've got a lot of strong policy views, and I don't want to dig too much into it, but those were some of my reactions. And I think, from the bond market perspective, the Treasury's making an announcement Monday, very, very important announcement. What's the refunding going to look like? Yellen's going to give us some insight on that. And I suspect she's going like this to Powell and say, we got to raise a lot more money here. You're going to have to buy some more. So initially, Powell's not going to do that because the markets are all-time highs. But we're going to get a correction in equities next month, 3 months from now, 6 months. That I don't know, but it's coming. And when it comes, you're going to see the Fed put step up to the plate again because they're going to have to. Or bond yields are just going to keep going up and up and up, and that's just going to crush the economy, and stocks are going to get worse. So at some point, they're going to step in, but it's probably not until equities have a big haircut. So there you go. We have 200,000 in US funds, but like to invest in ZPay. What would something like ZPay? Well, I don't know how much you have overall, but again, if it's something that, my colleagues with ETF Capital Management can help you with, by all means, reach out to us and we'd be happy to show you, what we can do for you in terms of generating yield in our private debt fund. So we've got a fund that's generating a 6% yield that has the volatility of a 3-year bond, right? If that's something that's interesting and you want that, it doesn't exist. There's no ETF for that, right? You've got to go to an investment manager that specializes in that. So if you need a yield to live on and you've got, let's say, $1 million, but you need 60,000 a year coming off that portfolio and you don't like volatility, well, let's put half in our model that looks like ZPay. Let's put the other half in our private debt and equity fund, generate you 6% more with a little bit of growth so that you're going to get, 7, 8, 9% with a great yield and really low volatility. If that makes sense for you, then that would be something, you need to consider. Now, again, the currency side of things, yeah, we look at hedging the currency risk too. So there's a lot of things that we can do that just don't exist necessarily in an ETF. But I don't have another recommendation outside of ZPay that would do something like that. So I stand to guess that you already own ZPay and you don't want to add to it. There's nothing else that I know that exists, although Purpose ETFs has a version of a ZPay that they do. Ticker symbol PSA, maybe. Have a look at that one. Similar strategy to ZPay, so maybe that works for you. But it's basically the same type of exposure, so you're not really getting any diversification there. Thank you for all you do in supporting Sick Kids Foundation. Well, I assume that means you made a donation, so thank you very much to you. I'm looking to diversify fixed income of my retirement portfolio, currently in GICs. 60-40, 40-60 is dead. I agree. What I just suggested was come have a look at what my colleagues at ETF Capital Management can do for you. That's not traditional 60-40, that's not GICs, that can generate a 5-6% type of yield on your portfolio with a very, very sleep at night comfort. Again, if that's something that makes sense to you, by all means, have a look. I guess BNN was talking about a low VIX. If it goes sub 15, would that mean a market sell-off? So no, we've seen VIX stay at the sub 15 level for 6 or 12 months without, you need a catalyst. Low volatility is not a reason to sell. Low volatility, when a catalyst presents itself, is a reason to sell with both hands. And that phrase comes from the futures markets, because when you're in the futures pits and you want to sell 5 lots, you do that. You want to sell 500, you do that, right? If you're a buyer, you do that. When you're selling with both hands, remember the Trading Places movie? Buy, sell, right? So when you sell with both, you need the catalyst. It's not in itself enough that the volatility is low. You need a catalyst for that. And if so, what economic or business rationale for low VIX? So the VIX can be suppressed if earnings keep going, if the Fed keeps the pedal on the metal, markets keep grinding higher, keep getting more ridiculously valued, VIX is going to keep going lower and lower. And that's the rationale. It's because it's artificial. If there was no stimulus, earnings wouldn't be doing what they're doing. Markets would be 1,000 points lower, maybe more from where they are today. Easy. Once the initial burst of the economy subsides and the stimulus is withdrawn, do you see the possibility of still rising commodity prices due to supply constraints? So, Drew talked about green energy, and so the biggest commodity is energy by far. Copper is important, and I think that's one where it's extreme right now by pullbacks. Lumber is another one extreme right now. I'm wary. Housing prices are going up. So there's a couple commodities. I wouldn't throw commodities in a basket and say commodities. I would say certain ones. Corn today, if you look at the price of corn today and go back 40 years, there were periods where corn was $5-6 a bushel. Corn has not gotten any more expensive in 40 years. It goes up and down and whatever. So again, you can't just say commodities. Supply constraints in terms of labor and output, there's some of that for sure. Supply chains are being broken, trade wars, getting products around, shipping costs go up when it's got to move on a dry ship across the water and so forth. So there's elements of that, but I think the world is amply supplied, and we're coming close to peak oil, I think. So I wouldn't worry about oil prices going up. On supply constraints because of non-investment. So what does the curve look like between reopening and demand for more oil and what the excess capacity is today? I think that's well in balance. But the oil bulls will color it up with a bullish story there. So lots of different, would this be stagflationary environment? And the answer would be yes, if we have, if we get into the midterm elections and Congress swings back to the GOP and they don't spend any money at all for the next 2 years, we're going to hit a fiscal cliff like this, right? And the deficits are still going to be running at $1 trillion plus a year. The Fed cannot taper. I'm sorry. So that talk to me is just nonsensical. But anyways, it is what it is. I do think a stagflationary environment's coming. However, as my good friend David Rosenberg says, bonds are still in a bull market. And to some degree, I agree with him. But where David's not tactical, right? I'm the tactical guy. And I think we've got this supply push coming. Bond yields are going to go higher. It's going to stress the Fed. Then they're going to go a lot lower. So there'll be a buy at some point. They're not a buy today unless you're talking about buying it for $1 or $2, on a long bond, right? I wouldn't be looking for much more than 142, 143 on TLT. Best case scenario next month. If the Treasury announcement is really bad, we're going back to 135. And if the Fed doesn't step in at some point, we're in a 130, 125, and bond yields, the 10-year is going to go north of 2%. So I agree with David that there's much more in terms of deflation and debt out there. The Fed will step on the gas, and at some point, Treasury bonds get very attractive to equities, and there'll be a natural buyer of Treasury bonds from that. We're out of time, folks, this week. Thanks for tuning in. Please consider supporting one of our partner companies or on the charity side so Jared and I can match your generous donations. I'd love to challenge everyone to $100 or $250. Pick your, leukemia research and cancer research for kids at the world-renowned Sick Kids Hospital or the world-renowned Baycrest Center here in Toronto that does groundbreaking research in dementia and Alzheimer's. So thanks. Have a great week, everyone. Next week, last week of the series, and then hopefully the golf courses will be open again, and Thursday nights I'll be out there. Be safe, everyone. Tomorrow I'm getting my COVID shot, number 1. Take care.